Picture this. You just got the news you've been waiting for. Your boss calls you in, slides a paper across the desk, and there it is. A raise. A real one. Not the insulting 2% cost of living adjustment. An actual meaningful bump in your paycheck. You walk out of that office feeling like you finally figured something out, like the system is starting to work in your favor. Fast forward 6 months, you check your bank account, and somehow, you have less saved than you did before the raise. Not because anything went wrong, not because of an emergency, just because life quietly expanded to fill every dollar you added to it. And here's the part nobody talks about. This doesn't just happen to people who are bad with money. It happens to almost everyone, and the raise itself is often the trigger. If you've ever gotten a raise and still felt broke 3 months later, this video is going to explain exactly why that happened, and more importantly, why it wasn't your fault, but also why it will keep happening unless something changes. Hit subscribe if you want more of this. Let's get into it. Let's start with the number that explains everything. Studies on consumer spending behavior consistently show that for every dollar of income increase, the average person increases their spending by 70 to 80 cents within 12 months. Read that again. You get $1,000 more per month. Within a year, $700 to $800 of that is already gone, absorbed into a slightly upgraded version of your existing life. The math that felt life-changing in your boss's office becomes almost invisible in practice. Economists call this lifestyle inflation, but that term makes it sound like a choice, like you sat down and decided to spend more. The reality is much more uncomfortable than that. Most of it happens automatically, invisibly, without a single conscious decision. Here's how it works in real life. You get the raise. The first month, you're disciplined. You save most of it. You feel good about yourself. Second month, you figure you deserve a slightly nicer apartment when your lease comes up. It's only $150 more per month. You can afford it now. Third month, you start getting lunch more often instead of packing it. It's just $10 here and there. Fourth month, you upgrade your car payment because the old one was due for a change, and you can handle the new payment. Fifth month, your social life adjusts. Friends at your new income level do slightly more expensive things. You keep up. Sixth month, you check your savings, and the raise has disappeared, not into one big thing, into 100 small ones that each made complete sense at the time. Here's what makes this pattern so hard to catch. Every single spending increase feels justified because it is, individually. The slightly nicer apartment? You work hard. You deserve it. The lunch is out? It's good for your mental health. The car upgrade? The old one was unreliable anyway. None of these decisions feel like lifestyle inflation while you're making them. They feel like reasonable upgrades that your new income can support, and that's exactly the trap. Because your brain doesn't calculate the cumulative effect of multiple small upgrades, it evaluates each decision individually, and each one passes the test. There's a psychological concept called hedonic adaptation, the human tendency to quickly return to a baseline level of happiness, regardless of what changes. It means the apartment upgrade that felt amazing in month 2 feels completely normal by month 4. So you need another upgrade to feel the same level of satisfaction. This is why raises feel life-changing for about 30 days and then quietly disappear. The income went up, the baseline recalibrated, and the gap between income and expenses stayed exactly the same. Now here's where it gets really interesting. Lifestyle inflation is the obvious problem, but there's a second layer that almost nobody talks about. When your income goes up, your social context shifts too, subtly, gradually, but it shifts. You start spending more time around people at your new income level. Your reference point for normal changes. What felt like a luxury 6 months ago starts feeling like a basic expectation. This is called social comparison drift, and it's one of the most powerful financial forces in human behavior. Because you don't compare your spending to your past self, you compare it to the people immediately around you. And if the people around you are spending at a level that matches your new income, which they tend to be because social circles self-sort by income, then matching their spending feels completely reasonable. It isn't a conspiracy. Nobody's pressuring you, it's just the invisible math of social belonging. Here's the second trap. When your income increases, you often lose access to benefits you didn't even realize you had. Certain tax credits phase out at higher incomes. Subsidy programs have income ceilings. Some employer benefits are means tested. Student loan income-driven repayment plans become less favorable. In some cases, not all, but some, a raise can actually result in a net negative in the first year once you account for lost benefits and higher tax brackets on the marginal income. The raise looked like a win on the paper your boss slid across the desk. The full picture is more complicated. Let's run the actual numbers on two people. Same job, same starting salary, $60,000 per year. Both get a $10,000 raise at age 30. Person A does what most people do, lifestyle adjusts, better apartment, better car, slightly higher social spending, saves roughly the same percentage as before, about 5%. Person B treats the raise differently, keeps their lifestyle exactly the same for 12 months, invests the entire $10,000 increase annually. Fast forward to age 50. Person A has been saving 5% of a growing income, roughly $200,000 total invested over 20 years. At 8% average returns, they have around $490,000. Person B invested the raise amount every year, roughly $10,000 annually, on top of existing savings, same 8% returns. They have approximately $740,000. Same raise, same job, same 20-year window. A difference of $250,000, not because person B was dramatically more disciplined, just because they made one different decision in the first 12 months after the raise, and they didn't let lifestyle reset their baseline. That's what lifestyle inflation actually costs, not the restaurant lunches, not the apartment upgrade. $250,000 in future wealth, traded for a slightly more comfortable present. So what actually works? Not cut everything and suffer. That doesn't last, and you know it. Here's the framework that behavioral economists call pay yourself first automation, and it's one of the only lifestyle inflation fixes that works long term. The moment a raise hits your paycheck, before you adjust anything, before you upgrade anything, before you even feel it, you increase your automatic investment contribution by at least 50% of the raise amount. You get $500 more per month. $250 goes straight to investments automatically. You never see it. You never make a decision about it. It's gone before lifestyle can absorb it. The other $250, spend it however you want, guilt-free. You earned it. This works because it removes the decision from your conscious mind, where lifestyle inflation wins every time and makes it automatic. You're not fighting your psychology, you're using it. The second thing that works is a 30-day lifestyle freeze after every raise. 1 month where nothing changes, no upgrades, no new subscriptions, no spending increases of any kind. This does two things. It gives you 30 days of data on what your finances actually look like at the new income level, and it breaks the automatic connection between income went up and spending should go up. Most lifestyle inflation happens in the first 60 days after a raise. Freeze that window, and you've already won most of the battle. Here's the honest truth about raises. They're not the problem. Income growth is genuinely good. The problem is the assumption that automatically comes with them. that a higher income deserves a higher lifestyle. It doesn't. Not automatically. Not immediately. The people who build real wealth don't earn dramatically more than everyone else. They just let their income grow faster than their lifestyle for long enough that the gap between the two becomes the foundation of their financial freedom. Your next raise is coming. The question is whether your future self gets any of it.